Everyone tells you 2008 was a mortgage crisis. Subprime loans, toxic securities, Lehman Brothers. That's the story they teach. It's incomplete. In July 2008, oil hit $147 a barrel. Before Lehman fell, before the bailouts, before Congress heard the word TARP. It was $147 oil that broke the consumer's back first, crushed margins, killed cash flow, and turned a fragile system brittle. The subprime fire was already burning. The oil spike was the oxygen. Now history is reloading the chamber. February 28, 2026. US and Israeli jets cross into Iranian airspace before midnight. Within 72 hours, Iran retaliates across 9 Gulf countries. The Strait of Hormuz, a 21-mile channel between Iran and Oman, goes dark. 20 million barrels of oil a day stop moving. Overnight, oil hits $90, then $100, then $119 a barrel in a single session, surging $52 in one day, the biggest one-day dollar move in the history of WTI futures trading. Gas up 35 cents in 8 days, diesel up 24%, jet fuel spiking. Every price tag in America is about to move. But the oil shock isn't the real story. Underneath it, there's $1.7 trillion in private credit loans, dry brush, stacked for 5 years, sitting inside shadow funds that most Americans have never heard of. Zombie companies, deferred defaults, borrowed time. And one firm, the single biggest player in this shadow market, already saw it coming. They didn't warn their investors. They didn't reduce exposure. They locked the exits. I'll show you exactly who they are and what locking the exits actually means for the people on the other side of that door. But first, you need to understand how we got here. Trump just dropped the match. This is how a war in the Middle East becomes a financial crisis on Main Street. Donald Trump ran on one economic promise above all others: cut energy prices in half. Drill, baby, drill! Cheap gas, American energy dominance. It was the centerpiece of his affordability message and the foundation of his second-term mandate. Then on February 28, 2026, he launched a war that is doing the exact opposite. Here's the pincer. On one side, Trump's maximum pressure campaign on Iran was always on a collision course with his energy promises. Iran sits at the edge of the Strait of Hormuz. Any military escalation with Tehran was always going to touch oil. That's not a side effect. That's geography. On the other side, the One Big Beautiful Bill, signed July 4, 2025, Independence Day, gutted clean energy tax credits, dismantled EV incentives, and killed the one pressure valve that could have cushioned an oil shock. Then he launched the war that created one. The result? The US economy is now 100% tethered to a barrel of oil moving through an active war zone. The numbers are stark. Strait of Hormuz flows collapsed from 19.4 million barrels per day down to 0.6 million, a 97% drop. 3 pipelines, 4 million barrels rerouted, 15 million missing every single day. You don't need a Bloomberg terminal to see the math doesn't work. For middle market companies, the businesses that employ most of working America, this isn't an energy problem in the abstract. Diesel is up 24% in a week. Transportation costs, manufacturing inputs, logistics costs, all moving simultaneously. These companies were already carrying interest coverage ratios of 2.3 times to 3.1 times, meaning their earnings barely covered their debt payments before oil spiked. Now the margins are getting crushed from both sides at once, and the Fed is paralyzed. PCE inflation was already sitting at 2.9% before the war started. Unemployment just ticked up to 4.4% in February. The economy is simultaneously slowing and heating, the textbook stagflation trap. Cut rates to protect growth, and you pour accelerant on oil-driven inflation. Hold rates, and the credit market absorbs a shock it was never built to survive. Trump is publicly demanding 1% interest rates. Powell can't move. Jeffrey Curry at Carlyle put it plainly: high debt and deficits make this oil spike more dangerous than the 1970s. Back then, the US could absorb the shock. Today, the private credit market is sitting on $1.7 trillion in leveraged loans to companies that were already struggling, and oil just became their executioner. But to understand why this is different from every previous energy shock, you need to understand what grew in the shadows while nobody was watching. In July 2008, oil hit $147 a barrel. Most people remember 2008 as the subprime mortgage crisis. The story of reckless banks, toxic securities, and the collapse of Lehman Brothers. But what the textbooks leave out is the oil. Because before Lehman fell, before the credit market seized, before the word bailout entered the daily vocabulary of every American, $147 oil broke the consumer's back. It crushed margins, killed cash flow, and turned a fragile system into a brittle one. The subprime fire was already burning. The oil spike was the oxygen. The parallel to 2026 is direct, and it runs deeper than most people realize. In 2008, the dry brush was $13 trillion in mortgage-backed securities. Cheap debt packaged, sliced, and sold across the global financial system. Opaque, interconnected, and completely invisible to regulators until it was too late. In 2026, the dry brush is $1.7 trillion in private credit loans sitting inside shadow funds run by Blackstone, Apollo, Ares, and Blue Owl. Same structure, different label. Here's what private credit actually is. After 2008, regulators tightened the rules on traditional banks. Dodd-Frank, stress tests, capital requirements. Banks pulled back from riskier lending, especially to mid-sized companies. Private credit funds stepped in to fill that gap. They raised money from pension funds, endowments, and increasingly from retail investors, then deployed it as direct loans to middle-market businesses. No public market, no daily pricing, no disclosure requirements, no early warning system when borrowers start missing payments. The market grew from $500 billion to $1.3 trillion in 5 years. By 2025, global private credit AUM was projected to cross $2 trillion. Blackstone, Apollo, and Ares built an entire shadow banking system, and the whole thing ran on the assumption that rates would eventually come down, defaults would stay low, and the companies underneath would muddle through. 2 of those 3 assumptions are now broken. The gate event happened March 8, 2026. BlackRock's $26 billion HPS Corporate Lending Fund moved first. Investors tried to pull out 9.3% of the fund in a single redemption window. BlackRock capped it at 5%. That gap, 9.3% trying to get out, 5% allowed to leave, is what a bank run looks like in slow motion. BlackRock is the largest alternative asset manager on Earth. When they lock the exits first, it isn't panic, it's a signal. Blue Owl followed days later, then the others. When the biggest shadow king in the room quietly bolts the door, it means one thing. The loans underneath are deteriorating, and they know exactly how bad it is. Default rates in private credit hit 5.2% in 2024, up from 1.9% in 2022. But that headline number is a fiction. The true default rate, accounting for restructurings, payment in kind toggles, and covenant amendments, is running closer to 10 to 12%. The accounting flexibility of private credit allows fund managers to defer pain indefinitely. Here's how it works. A zombie company can't make its interest payment in cash, so instead of defaulting, it issues more debt. The new debt covers the old interest. The loan stays current on paper. The balance sheet quietly rots underneath. It's called a PIK loan, payment in kind. Think of it like paying your mortgage with a credit card. You're not behind. You're not in foreclosure. But every month, the hole gets deeper, and the bank keeps telling investors everything is fine. That's the machine that's been running since 2022. That's what BlackRock and Apollo and Ares have been managing inside these funds. And that machine just ran into $100 oil. That's where the 2008 echo gets loud. In both cases, the damage is hidden in the structure, not visible until the moment it becomes catastrophic. Section 3. The zombie apocalypse and the cascade. Now add $100 oil. Rating agencies had already flagged 15 to 20% of private credit borrowers as zombie-like before the war started. These are companies that can't generate enough cash to cover their debt payments. They've been surviving because lenders keep extending and pretending, rolling loans, accepting PIK toggles, quietly waiving covenants. The strategy works as long as the macro environment stays stable. The moment a real shock arrives, the math collapses. The energy spike is that shock. Middle market companies are running interest coverage ratios between 2.3 times and 3.1 times. That means for every dollar they owe in debt service, they're generating roughly $2 to $3 in operating earnings. Thin. A 24% jump in diesel costs doesn't just compress margins. For a company at 2.3 times coverage, it can push the interest coverage ratio below 1.0 times. That's the technical definition of insolvency. Not distress, insolvency. And this hits simultaneously across every energy-intensive sector. Trucking, manufacturing, agriculture, logistics, retail distribution. The companies that form the backbone of employment for working-class America. These aren't abstract balance sheet numbers. These are payrolls. $570 billion in private credit loans mature annually through 2027. Those companies need to refinance. And they're walking into a market where rates are still elevated, oil is spiking, lenders are getting nervous, and redemption gates are starting to go up across the industry. The refinancing window is closing. The cascade runs like this. Step 1. Energy costs spike. Step 2. Zombie margins go negative. Step 3. PIK toggles accelerate. True defaults breach 15%. Step 4. Shadow kings start writing down fund values. Redemption gates go up across the industry. Step 5. Pension funds mark losses. And retail investors who bought semi-liquid private credit chasing 10% yields discover what illiquidity actually feels like. Unlike 2008, there is no Fed backstop here. Blackstone and Apollo are not Citigroup. The government cannot recapitalize a private credit fund the way it recapitalized the banks. There is no TARP for shadow banking. The losses go directly to whoever owns the fund, pension funds managing the retirement savings of teachers and firefighters, university endowments, and retail investors sold on the promise of uncorrelated yield. The IEA estimates a one-month closure creates a 600 million barrel supply gap. The G7 is considering releasing 300 to 400 million barrels from strategic reserves, the largest coordinated release ever attempted. To put that in perspective, the entire USSPR holds roughly 360 million barrels. This move doesn't just draw down reserves, it empties them. It covers 2/3 of the gap for 3 weeks. After that, there is no buffer left. That's not a policy response. That's desperation made visible. The economy runs entirely on fossil fuels at the exact moment fossil fuels are flowing through a war zone. And consumers are cracking. Gas at $3.48 a gallon and climbing toward $4. Grocery inflation re-accelerating. The New York Fed's latest consumer survey shows inflation expectations rising sharply. The 10-year Treasury yield is back above 4.17%, pushing mortgage rates higher into a housing market already stretched to the breaking point. This is the bind. End the war and absorb the political cost of backing down from Iran. Or hold the line and watch the financial system absorb an oil shock it was built to survive for weeks, not months. There is no clean exit, and the clock is already running. The Trump administration walked into a trap of its own construction. Maximum pressure on Iran, maximum exposure to oil, and a $1.7 trillion shadow banking system that was already rotting from the inside before the first missile crossed Iranian airspace. The question was never whether private credit would crack. The question was always, what lit the fuse? Now we know. Watch 3 things. First, the Hormuz reopening timeline. Because every week that strait stays dark, another $100 billion in supply disappears from the global market. Second, the Fed's next move. Because cutting rates into $100 oil is a different kind of catastrophe than holding them while zombie companies fold. Third, and most important, watch whether more private credit funds start capping redemptions. Blue Owl, BlackRock. Who's next? Because when that third domino falls, the cascade doesn't stop at the shadow kings. It moves through pension funds, through endowments, through the retirement accounts of people who never heard the words private credit in their lives. The Strait of Hormuz is 21 miles wide. The financial crater it could leave behind is $1.7 trillion deep, and most Americans won't see it coming until the day they do.